Susan. I know you just flown back yesterday late last night, so thank you for being here with us. So let's start with, how's business been going?
Good morning, everyone, and thank you. Pleasure. Business is doing really well. I have to say that, and probably everybody will hear the sentiment, the previous session, Hong Kong's really booming. So we're seeing this across the region from a asset management and growth perspective. So.
Business has been going well. Volumes are up, as Paul Chen said, 400 billion. If we think of how investors are allocating from an asset allocation perspective, what are you seeing across BlackRock?
So in terms of allocation, Asia continues to be a region that really embraces active strategies. So we are seeing the growth continue around the active mutual funds. We are considering to continue to see growth in ETFs, something very close to our hearts. And more and more, though, we're also seeing allocation into the private markets. So really three key themes. Let me just touch upon the active side for a minute. So in active, what we do see is the desire for more thematic funds. We see the play on income continue. Income story is no stranger to us in the region. Everybody wants income, so now people are looking for diversified methods to generate that income. In particular, we see high demand for hedge funds. We see high demand for systematic funds as well. So that has been the lion's share of the growth coming from across the region.
So if we drill into the active, as you mentioned, what some of you may not know, Susan and I both started, we know each other from ETFs. Susan was head of capital markets at BlackRock for iShares, and as you know, ETFs has grown significantly. In Hong Kong, it's now surpassed 100 billion in assets under management, and active is a big thing. To your point, in Hong Kong, there's a lot of active ETFs that provide very good income. And Hong Kong, amongst Asia Pacific, is one of the highest in the region. Some of the ETFs provide more than 20% income paid on a monthly basis. So as a house that has both active and passive, how do you see the two coexisting?
So we fundamentally believe that we needed to bring the two together, and we did this when we brought BGI into BlackRock. And that narrative has absolutely played out in the sense that all decisions are active decisions. Whether you're choosing an active fund, whether you're choosing an index fund, whether you're choosing a private market investment. So I think that's how it's playing out. What I would say is that it's incredibly exciting times right now for us, for all of us in the industry across the ETF space. Globally, ETFs are around 22 trillion. In Asia Pacific, it's only north of 1 trillion. So just think about that for a moment. The other stat is today, Asia Pacific accounts for 18% of global assets under management for our industry. That's expected to grow to north of 25% by 2030. So if you couple those two numbers together, what you'll see is there's going to be tremendous growth in ETFs. The size of our capital markets across the region, one would expect that 1 trillion can go to 10 trillion, can go to 20 trillion if all the countries focus on driving and growing their capital markets.
I think to leverage off that point, for us, within Bloomberg Intelligence, our estimate is that ETFs globally will surpass 50 trillion by 2035. So right now we're at 22 trillion, but we expect it to surpass 50 trillion. So definitely tremendous growth across that. Now you mentioned about thematics and themes. Can you comment on the recent AI tech sell-off?
Let's see. I think it was mentioned, there's an IPO. There is a listing that's going to happen on Friday. There's been a lot of talk about how are you going to fund these big mega IPOs. Some of the sell-off is to raise cash, right, to invest. Another sell-off is simply what's happening in the Middle East. So we do have some macro forces that are creating some events that has caused the Friday sell-off, the Monday sell-off. But then yesterday, the markets did rebound. And this, to me, is showing that clients are willing to put money to work. Every sell-off, we don't see a rush to de-risk If anything, we do see selective position risk on again, and we're seeing that yesterday. So I think, this is an opportunity for us to look at where there are pockets to generate that alpha return. And our investment teams are doing that. Our clients are expecting us to do that. Sure, the markets are volatile, but when markets are volatile, that is the opportunity for us to generate excess return. So I think it's fine for now. It doesn't mean that the markets won't correct 20 or 30%, right? But I think all markets globally has proven to be incredibly resilient.
I think if we look at the markets, they have performed phenomenally well. And if we shift gears slightly into crypto and tokenization, crypto, you guys do have the largest Bitcoin ETF globally. Let's talk about crypto. Hong Kong's trying to be the crypto hub. We've done a lot in tokenization now. In Hong Kong, you can buy an ETF and then switch it into gold and get gold jewelry or gold bars back. What's BlackRock doing in this space?
So we have, as you mentioned, we have our crypto ETFs. We continue to see demand for that, and that will continue. We are working across the region in many countries to see how we can bring that capacity into the countries. We've actually listed in Australia, and we're looking at other areas that we can do more in, including Hong Kong.
So if we look at the investment opportunities across Asia Pacific, where does BlackRock see as the most compelling investment opportunities?
So I think there's a few areas, right? So if we look at countries, because of AI, we're seeing structural shifts. Where are they taking place? Well, Korea, for example, is one big shift. If we look at what's happening there with just the AI theme playing out and taking companies like Samsung and Hynix to an incredible level. And even last week when we had the MSCI rebalance, the weight of Korea in the EM markets went from 8-9% to now 22%. These are fundamental shifts that are not going to, revert. So that's Korea, that's Taiwan. In addition, we see Japan as a destination now because of the end of deflation. Of course, that's going to take some time to play out, but there is a lot of interest in Japan. In particular, in Japan, I would say is in the private market space, in the private credit space, in the infrastructure space. So that's another area that we see a tremendous opportunity. And then in the ASEAN countries, what we are seeing is this need for diversification and this need to want to invest outside of home country. Part of it is driven because of the weaker currencies in the ASEAN countries. They need to diversify to have dollar assets so that they can balance their portfolios over time. And broadly, we're seeing clients wanting to further diversify. What I would say, Rebecca, is that the traditional 60-40 type of portfolio allocation is really underperforming. And we're finding that the need to think about that portfolio on a holistic manner across both equity, fixed income, private, public is really critical today. We're also seeing that you have to look and be very deliberate about how you select what's in each of the categories. It's no longer that you can just go buy an active equity fund and expect to generate the returns in active. And also, there is the demographic challenges of every country in Asia. And we are living longer. We have pension challenges across all. And portfolios of the traditional 60-40 are not going to generate the outcomes that we're going to need for the future. So this is why private markets is becoming such an incredibly powerful asset class within the longer term portfolios because you need it. And it fits very nicely in so many ways, right? In terms of long-term returns, when you're saving for the future, you're less dependent on short-term liquidity. but you need to be able to see those returns and also what you're investing in private markets. Nowadays, we always look at how do we help the countries. So infrastructure, you invest in country. So it's a way for you to also, as an investor, have a part in the development of your country.
So you mentioned private markets. It's very hot right now. You guys are heavily invested. You made 3 large acquisitions recently into private markets, but there's been a lot of negative news around private markets, especially private credit. Investors not being able to get out of positions. There's been a shortage. What is your take on this?
So don't always believe what you read in the press. Headlines are meant to be sensationalized. That's number one. Listen, there are pockets of issues in private credit, but it's really very idiosyncratic and it's very unique at the moment, okay? If we look at the overall categories, they are doing well. They are offering the diversified returns. And we at BlackRock, you said we made the acquisitions, we firmly believe that you cannot build long-term portfolios without going into areas like infrastructure, like private credit. I would say that, with any portfolio, you have to look at it on a risk-adjusted return basis. You also have to be able to due diligence and deploy your capital where you feel is, the right area. So, I think, sure, there are some pockets, but if we look at the grand scheme of things in private credit, the default rates are still very, very small.
And then you mentioned portfolio construction, traditionally the 60-40. How are investors constructing portfolio now? To your point, there's so many different products out there available.
So what I would say is there is probably the adjustment of 60-40 within the public markets, and then increasingly we're seeing allocation into private markets. So some of you may hear people saying 50-30-20, of which 20 is in private markets, or there's a blend. So we're definitely seeing more and more of that whole portfolio holistic look as into the equity piece, the fixed income piece, and then the private piece. And it helps to boost your longer term returns.
So you mentioned previously income. In Asia, typically investors will invest mainly in cash and property. And it's very different to the US where people have retirement funds, they're using ETFs. How are investors different in Asia than the rest of the world, do you find?
Well, I don't have to tell you, and we all know, Asia traditionally will save a lot in cash. But this is what makes Asia so exciting, because we are seeing that shift gradually, right? Where savings is moving into investments, where most of our clients are seeing that if you did not invest in the capital market, you would have missed out. Last week I was in Shanghai, and I spoke, and I gave a number that kind of was fascinating to everyone. So here's the number. If you invested $1, right, into China's equity markets over the past 20 years, you would have on average generated 6.5% per annum, okay? That is extraordinary. That's like more than 300 times over the past 20 years. If you sat in cash, you would not have done that, okay? These are just the beauty of compounding in capital markets is incredible. Now, if you do that in every single market, you will see and you will convince yourself that you should not be sitting in cash only. You may want to sit a little bit, but you should not be sitting in cash only. So we do have to start investing in local capital markets and, of course, the diversification into global markets.
So if we look across the region and across the product offering, there's a lot of investment opportunities. Where do you see are the most undervalued opportunities within Asia Pacific?
Listen, I think China, because we went 18 months ago where globally the world was like, China's not investable, China is not investable. Today, we're seeing a lot more attention on China. The valuations are, on a relative basis, cheaper. There is value, and there's a lot of value. And I think we're going to see that play out as the mega forces of AI start to play out, as this theme of Asia for Asia, because our investors want to invest more closer to the region, plays out, we're going to start seeing that clients will look towards those undervalued plays. So I definitely think China is one. The second one is Asian credit. Asian credit yields incredibly well. It traditionally has not had the attention, and I'm saying public credit. It traditionally has not had the focus because of the fact that it's largely a primary activity tool and secondary liquidity is less. So we all need to do some work there to promote and get secondary market active liquidity up. But Asian credit, we see tremendous opportunity in that category as well.
So if we look to the next 3 to 5 years, you mentioned China, Asian credit, any other sectors that you think will outperform? Or what would be the best ways for investors to express their views?
Well, I think, again, construct your portfolio with the blend of, you're going to have to invest in the US. With the largest capital markets, it's very hard to stay away from it. But I think for every incremental dollar that you're putting into the markets, think about how you should diversify, both as a hedge, but also as a diversification, because certain pockets, yields are higher in Asia, right? So we do see home country investments in all countries as something very important. The AI theme will continue to play out, but it's going to start going downstream. So think about that downstream effect and what other segments within AI and what other sectors are going to benefit. Obvious ones are going to be healthcare, biotech, et cetera. So look at how to diversify on that. Blend fixed income, blend Asian fixed income. That category is incredibly resilient and is a great diversifier. And then lastly, private markets. And I think in private markets, for us, it's about infrastructure. It's about private credit.
So if we look at what Secretary Paul Chan has said, did you have any comments of what he said?
I agree with what he said.
Hong Kong's going to be the hub. Before we end, we're asking every panelist this question: how is your organization using AI, and what's the impact to the job market?
So at BlackRock, we've been leveraging AI for a long time in certain parts of our business. We have a systematic quant group that has been experimenting and leveraging the AI tools for more than 2 decades. So that's number one. Number two, we are looking at how we can further embed AI into our processes. But what I would say is it's very early innings right now. Everyone is experimenting with AI, and we know that it will help to increase productivity. We know that it will help make our day jobs more efficient. So that's for sure. What I would say is that, the use cases of where we will apply AI has to be structural, strategic, and it has to be on a scale level. Okay, and sure, everybody will have their co-pilots, et cetera, but I think that is just sort of norm. So we're still testing, but I would imagine that we're gonna, have multiple use cases.
Hopefully you did not use AI to come up with any of these answers.
I did not, because I didn't know what you were gonna ask me. So, and then also I think you asked about talent. So, again, I'm going to talk about, in terms of talent and the use of AI, we do believe it's a way to enhance and make our folks and our day jobs more efficient. Sure, we're talking about what new jobs don't exist today that will come in the area of, for example, governance. We're talking about what tasks can be leveraged and how we can retrain our colleagues to move up the stack. And I'm super excited because if I get an hour back, I can do many other things in that hour.